Eric Muathe at Muathe.com. So what I'm going to do here is through a series of videos, probably some old ones, some new ones, I'm going to tackle this subject of exits. When to exit is a question I get all the time. So what I'm going to do here is, number one, take a look at the series of videos where I discuss this high here. And I think it's about 4 videos. And the understanding of what I was saying in those 4 videos do help crystallize why this was where the high was made. So if you understand what I was looking at in those series of videos, there might be 3 of them, maybe 4, but I'll have them in the description, because the question of exit is a good one, but also it is one that is a little bit tricky, honestly, because there's nothing in this particular example. So really there's nothing that prevented this stock from going higher other than the market itself. And so yes, on hindsight, clearly this is the high, but that's on hindsight. When you're trading here, it's not as easy. But I'll discuss all these things in this video, and also it's going to be a brief one as far as this video is concerned, but like I said, I'm going to have a series of videos that discuss this topic of exit strategy. As an example, take a look at where the FTSE is trading. So the FTSE right now trading right there. So the question I'm sure traders are having in that market is, can they continue being long? Well, it's a good question. But now let's take a look at some of the surrounding factors that can help us determine whether this is a high that we can take advantage of in anticipation of a drop, or whether there's going to be a shallow pullback, and before we know it, it's trading at 8,000, right? Right now at about 7,300. So we don't know. But so the main thing here actually is the word strength. So if I was to crystallize and to summarize how you can start looking for situations where a stock is about to make a short-term high, it pretty much comes back to this word here. And what we are talking about here is not the price strength, not the price. No. What we are looking at is the strength of the sentiment. So most of what we are going to be looking at pretty much boils down to a simple idea. What is the strength of the sentiment? How bullish is the instrument? And the way we can tell the sentiment is to consider the RSI. So pretty much when trying to determine your exit point on the way out, let's say in a situation where the stock is moving in your direction, then you have to resort to looking at this. What is the sentiment? Is the sentiment still strong? Are you running out of bullish sentiment is the question. And how you check that out is to consider the RSI. Because in my opinion, if you just consider price action only, price action for the most part is going to deceive you. Okay? And so, the first rule that we should always be observant is 69.1. Not the first rule, but I shouldn't say the first rule, but one of the things we should always be careful is to try and anticipate a pullback when a stock is trading above this number. So if you take a look at the FTSE, it's not above 69.1. So it's not, the sentiment is not ultra strong. So if I was to consider, is this an exit? Maybe, maybe not. And I can also see that prices here have moved for 1, 2, 3, 4, 5, 6 weeks in a row. If you take a look at this 2-year weekly chart, there's no other period where we have 6 weeks to the upside. Maybe this week here, 1, 2, 3, 4, 5. Okay, so it's not as strong as far as the weekly is concerned, let's take a look at the daily. And on the daily, first thing we can see here is that the sentiment is above 69.1, which means we cannot start selling this or trying to short this market. It doesn't matter that it's been up at, I believe, throughout all this, I think 12 days or something like that. It's been up a lot. All these days have been positive, which is consistent with markets when they move above 69.1. They don't go up every day, but as long as the instrument is above 69.1, this is not where you want to get out. In fact, if you own the position, then this is a good guide. You stay in the stock or in the market as long as the RSI is above 69.1. Now, it seems very tough to believe that, but that's pretty much the basic understanding of sentiment. So remember, we talked about strength. Well, when an instrument is trading above 69.1, it is screaming at you that it is absolutely strong. And so we have to account for all these time frames. Let's take a look at the monthly here, and we can see that the FTSE also on the monthly, as of right now, is holding its RSI and moving it to 3-year highs. So that's one of our minimum requirements. We take a look at the FTSE, we take a look at the MACDs here, and the MACDs, we see one of our MACDs breaking out to 3-year highs. So we can tell from this that the sentiment is very strong. We take a look at the hourly. That's the daily. Take a look at the hourly, and the hourly is not bad. It's just now moving back below 69.1. So if you take the daily, the daily, hourly, weekly, and monthly, and especially the fact that we have our daily RSI above 69.1, if you're looking for an exit, this is not it. The exit is going to come at some point when it drops back below 69.1. And even that's not going to be it. But we'll cover that in another topic. But for now, as long as the RSI is above 69.1, this is not the high. The high generally comes afterwards. So what generally happens is you come off 69.1, you move higher, you stall, prices pull back slightly, make a new high, and then you stall. And that is when you set up the stage for negative divergence. A high made with declining strength is more reliable, and so the subsequent sell signal will come at a higher price when the RSI makes a lower high, and that's negative divergence. Improvement in prices, declining strength. Remember, we are summarizing when to get out of a stock pretty much by trying to figure out if we are running out of technical strength, not price strength. As an example, even on this chart, we can see that this was the short-term high here. That corresponded with improvement in price highs while the RSI made a lower high. The high was not here. Yes, it pulled back. Here, there was a pullback. But ultimately, we go to new highs, and it is the negative divergence that leads to a bigger drop in percentage terms, and also duration is longer. The duration of this high after it made a lower RSI high. In other words, RSI ran out of strength here while prices were making new highs there. That was the stage for a pullback. And that's the other thing also. Maybe I should just say this right here. Your biggest tell as to whether there's a pullback is this idea of negative divergence. Now, this idea does show up also in terms of uniformity resistance. As an example, this chart shows it. All right, so the break here, let's change that a little bit. So the break, let me get my color correct here. So the break there gave us the warning break. Now what you'll notice is that stocks tend to give you a warning, and this initial break is a warning signal, and we can confirm that because the stock comes back and tries to move above that level and is rejected twice, here and here, for the highs there and there. So again, this was your warning break. You get a shallow pullback, causes people to go short, but this is now where they want to get people all confused. People are joining in, going long, bears are being stopped out, but it's all confusing because the high comes now here, and you can see confirmation of this because of negative divergence. In other words, because we ran out of technical strength as we recorded the high. Remember, strength is the key. So in this particular example, what I'm trying to say, I hope it makes sense, is until we see the RSI make a lower high, something like that, we have to assume that even with a pullback, as of right now, we are still going to see another high. Please understand that. And that's pretty much. Now, yes, there are instances where the RSI is going to pull back below 69.1, and that's going to be your high. In other words, the prices are going to come back, and this sometimes can be the high, and it never looks back in price. But generally speaking, your major highs are going to come with this negative divergence. It's just how it is, because this is what captures declining strength. Underlying strength declines while prices make a fake high. But now maybe the question becomes, but what time frame do we look for negative divergence, right? What time frame? What if the negative divergence shows up on the hourly time frame, right? What time frame are we looking at? That's a good question. Well, I'll say this. So we have, let's take the main time frames. I'm not going to go to minute charts because we are not day trading here as in this example. So we got hourly charts, we got daily charts, weekly charts, and monthly charts. If you are really looking for any type of an out, let's say you've had a nice run, let's say you bought this stock and you've enjoyed this run, you want to lock in profits. Now what you can do is take any negative divergence in either the hourly, the daily, the weekly, and the monthly. Keep in mind, because we are using RSI of 26 in our hourly chart, it's a long period. 26 hours is a long time. So let's take a look at, so 26 hours on the RSI on the hourly, pretty much what we are saying is so we take 26 hours divide by I believe the US market trades for 6.5 hours, so we go divide by 6.5. So we're talking about 26 hours, about 4 trading days. So even our RSI setting of 26 is pretty much like a daily chart. Hope that makes sense. So again, if you're looking for any excuse to get out, what you're looking for is running out of energy either on the hourly or on the daily or on the weekly or on the monthly. Now remember, you're not going to sell at the high, at the very last micro, you're not going to get it out at the very last, and you're not going to sell it right there and it drops back. You might sell it off by a couple of points here and there. That's fine. All you're trying to do is get as much of the trade as you can. There's no need to stress yourself in trying to milk the very last penny or cent. So let's take a look at some real life situations. So for example, if we take a look at this instrument here, India Glycos. I hope I'm saying it right. So this is one that we looked at in terms of meeting the minimum requirements. Looks great. It's breaking out this past 2 weeks. Okay, so let's take a look at this weekly chart as an example. The RSI is above 69.1. So if you are looking to get out, well, you can get out when the RSI is above 69.1. So that forces you to stay. Okay, we take a look at the monthly chart just for clarification, and we can see that the monthly chart, of course, meets the minimum requirement. It is breaking out to 3-year highs right there. It is holding above MACDs to 3-year highs, so definitely meets the minimum requirement. That's why it's been doing well. Keep in mind also, we have to keep an eye here on the monthly. If the monthly moves above 69.1, well, we cannot sell it until the monthly chart comes off the 69.1 level. So that's something to take a look at, also to consider. If we take a look at the daily, the daily RSI is above 69.1. So you got your weekly charts above 69.1, you got your daily above 69.1. So you can start seeing that these are reasons enough to hold. Now let's say you have 100 shares, but you feel like you need to get out. You can always sell 20 shares and hold the other 80, because the weekly RSI is above 69.1, the daily is above 69.1. If we take a look at the hourly, just to see what the hourlies are doing, and you start seeing the first signs of running out of energy, you got your improvement in hour-to-hour price highs, but you got declining technical strength. In other words, the negative divergence we're talking about is showing up on the hourly chart. So if you felt like you wanted to take some quick profits, then if you have 100 shares, again, you can sell 20 shares, you can sell 21 shares, you can sell 30 shares, but you want to keep some of the shares because you don't know that this is just a shallow pullback before you continue higher. Why? Because the daily is still good, the weeklies are still good, the monthlies are still good. Okay, let's take a look at the Nifty here, and we want to take a look at these highs here. How would one have known that this was a level to watch for potential resistance? Now, of course, we can see that there are a couple of things that happened at the time. There was a trend line break. Oh, by the way, I have to say this. Remember, you don't have to sell this at that high right there. If you are part of this move, any of this move, and you wanted to get out, on hindsight, even if you got out somewhere here, that's fine. Okay, let's not stress ourselves with trying to sell right there. Okay, that's almost unrealistic. But on this chart, a couple of things we can take a look at is, number one, to understand what was going on here, because I remember this was not a surprise that the market came off the highs there for many reasons. You go back and take a look at this breakout attempt on the monthly. It failed. So you gotta ask yourself, why was it failing? Well, the answer is, now you can see why. There was no belief. There was no technical reason why the bulls at the time thought that the market could hold up. Okay, so that was one thing that we looked at. We saw the failed breakout there. It's not a good sign when a market cannot break out. And while I'm here, actually, I can see another example of another failed breakout here during the highs of early 2015. So the market stayed above that breakout level for 1 or 2 weeks, subsequently failed, went back below that level. So that was a warning also. And also keep in mind, if you take a look at this, you can see that there was an improvement week to week price highs there. But take a look at the technical picture. Technical picture was showing that we were running out of strength. Again, there's that word. So you're running out of strength, and we're talking about sentiment strength. Or since we are looking for highs, you're running out of bullish strength. That's why you made a new high with declining strength, which is running out of juice, and eventually you roll over. On the weekly chart, we can also see that there was evidence of trend break right there. Trend break would have meant getting out somewhere here, and that's fine. Don't worry about trying to get out here. At the same time, you can also see here, recently there was a trend break. That trend break was in sometime towards September, October for the highs there. And keep in mind, we already talked about another failed breakout here. Failed breakouts are notorious for taking markets and stocks lower. Also, if you combine this with the monthly chart during this period, let's take a look at the monthly at this particular point in time. And you can see what the monthly was doing. We have a market that was moving to a breakout attempt, but with declining strength. So that was not good. You can also see evidence here of a failed breakout. Closing high. And you can see here, it never closes above the previous monthly high. This was the monthly high of 2015. It tries to close above it here, fails. Tries here again, fails. Tries here again, fails. Now keep in mind, now think about this. This took 3 months to play out. Are you that patient? No, seriously. 3 months. That's a long time. But that's the reality of it. These things take time, and we have to respect and honor that. Because if we are trying to always trade and get everything perfect on the very day, on the very minute, it's a lot of stress. But the reality is that these things take a while. We take a look at the daily. And on the daily, we can see an example here of a level here where the RSI goes above 69.1, is rejected twice. That is double top rejection at 69.1, right? Which coincides with the ultimate high here and here. And the market never comes back to make a new high. The market doesn't make a new high with declining technical strength. The high was the high. In other words, you'll see this on the daily here. Double top rejection, that was the high. The market doesn't make a negative divergence, it drops after that. But I'm going to explain this to you because you gotta put all these things in one big picture view. Monthly charts were showing that the monthly charts were stalling, failed breakouts. Weekly charts were failing to break out. And also we can see that now, if I was to show you what the daily was actually doing, in my opinion, pretty much there was a warning break. So this warning break here in August was for the highs there. We draw a line from here. So this red line represents what I think happened, in my opinion. You have to understand the uniformity principle. Here you go above the red line and back below it with uniform activity. That's why this was a trap. Whenever you see uniform action in the RSI, as defined here by uniform activity, it tends to correspond with an area in the market that for the most part is a trap. And so once you break below that red line after you confirm uniform activity, that becomes a sell. And again, even in this example, we see that the sell, you don't get the sell signal here, you get it a little bit lower. And that's fine too. Speaking of that, right now we're looking at the Indian market coming back to test that line. If it fails, that might be a point of reversal because this line was good enough to stop these highs from seeing higher prices. The market pull back. The RSI is coming back to test that line. So just for the point of real-time analysis, if it stalls here, then clearly it is due for a pullback. Hope that makes sense. Let's take a quick look at one other random stock that is doing well over the last couple of days. Here was an explosion in price, moving from $6 to $16. So this is a huge question in relation to how do you time a high. let's say somebody wants to get out of this position. It's a big question mark. What do they do? Do you get out now? Well, let's consider what we've been discussing here. Take a look at this daily chart. And this daily chart shows that the daily RSI, right now the daily is holding above 69.1. So clearly the daily is saying don't sell it yet. Okay, we take a look at the monthly chart. Number one, we can see the reason why the stock is exploding is because it met the minimum requirements. On hindsight, one can see that the RSI broke out here in October-November time period. That corresponds with the MACDs moving to all-time highs. So it met the minimum requirement as far as the ultimate Muathe breakout is concerned. So no surprise that since the breakout right there, that the instrument has gone on to record a substantial increase in price. Now the magnitude of the increase is absolutely phenomenal, but it met the minimum requirement. But for the sake of trying to figure out an exit, take a look at where the RSI is trading. On the monthly, as long as the RSI is above 69.1, there is no need to be stopped out of that position. We take a look at the weekly. The weekly has maintained levels above 69.1 over the last 4 or 5 weeks. So as long as the weekly is above 69.1, you can hold on to part of your position. So again, let's say you own 100 shares, you could still be owning 75 shares or 60 shares. Why? Because the RSI on the monthly, daily, and weekly are above 69.1. On the hourly, we might start seeing the first evidence of running out of juice, running out of energy, improvement hour to hour, RSI declining. So that negative divergence might set the stage for a pullback. So let's say you don't know what to do here, and now you still have 75 shares of your original 100. So you sold 25, you can sell 15 more because of this negative divergence. But there's no real reason to sell the entire remaining portion of 60 shares, because you got your weekly chart showing strength above 69.1, you got your daily chart showing strength above 69.1, you got your monthly chart still showing strength above 69.1. So the key is, do not try and figure this out in terms of block trading. So don't buy 100 shares on your way in. Let's say you bought the stock there, and don't sell 100 shares on your way out. So don't sell the entire position, let's say here. If you go in portions, if you make your purchase, go in, buy a couple shares, buy 30 shares, and then buy 40 and finish out with 30 on your way in. That's the best way of doing it. And on your way out, you do the exact opposite. This is going to reduce the stress. So you might sell 50 shares initially on your way out and another 50 after that. Really, there's no hard science into what position size you should take on your way in or out. But what this does is it buys you the luxury of reducing your stress levels. So again, a good study would be to, in understanding this, take a look at the chart for TBT, because I believe I tracked this over a period of weeks during these highs, and ultimately what happened is we got negative divergence on the daily, and that is when it made a high, which also coincided with the hourly chart making an improvement in prices while the RSI made lower highs. And this is ultimately where it stalls, somewhere around here. So take a look at the video description for the series of videos discussing the TBT exit, because I go into details and what I was looking at. And don't forget, the key for that instrument was the monthly chart. And the monthly chart was coming back in essence to test the line where it had broke down in 2014. And so from a big picture standpoint, I knew that this is what was being tested. The idea was just to wait for this to play out. Remember, it took it about 3 months for all this to play out, but ultimately you can see what has happened. So let me end the video there. This is a good beginning, or at least the first of many to come on the subject matter of exits. And I'm going to end this right here with stating that the biggest takeaway is you got to figure out what a stock is doing in relation to strength. It all boils down to strength, and when we talk about strength, we're talking about technical strength, and technical strength can pretty much be gleaned by understanding how to use the RSI. So this is the first of many. Otherwise, we'll keep this conversation on exits going. Eric Muathe with Muathe.com. As always, good luck, peace, and blessings.